Okay, so now from this picture, we could see words such as Bitcoin, e-banking, P2P, car loan, financial management, and risk security. All of these terms on the screen converge into a keyword, fintech, a technology that is reshaping traditional finance. Viewing from the evolution of the financial services industry, it has progressed through the stages of traditional finance, internet finance, and fintech. The traditional finance stage was primarily driven by financial information technology, with the core institutions such as banks, insurance, and security firms. The internet finance stage was propelled by network information technology, countered around third-party payments institutions like Alipay and WeChat Pay. However, the fintech stage, whether in terms of foundational technology or principal risks, is markedly distinct from both traditional and internet finance stages, embodying a new generation of fintech technology that is both constructive and destructive. Fintech is revolutionizing the dynamics of the financial ecosystem, fundamentally altering how banks, businesses, firms, and households interact. With the development of fintech, banks can now offer a diversified services through user-friendly online platforms, breaking geographical barriers through user-friendly online platforms and improving operational efficiency with AI customer support and robotic call centers. Moreover, the utilization of big data also allows banks to precisely target customers and tailor services to meet their diverse needs. Utilizing the big data to analyze the customer behaviors and the social network data. In addition, by using AI algorithms and blockchains, banks can now accurately assess the customer risk profiles, enabling informed decision-making on loan provisions while mitigating risks faced by many traditional banking systems. This would help to reduce any adverse selection, leading to a more efficient process of screening and the monitoring of our clients. Furthermore, fintech has also had a transformative impact on the small and medium-sized enterprises, the SMEs. Startups, in particular, benefit from fintech's ability to connect them with a broader pool of investors through crowdfunding platforms, fueling innovation and growth within the SME sector by using fintech methods to issue microstocks and implement smart contract-based dividend or profit-sharing plans. SMEs can expand their scale of operation and attract a broader social capital participation, which can promote sustainable growth and innovative development. On the individual level, fintech could offer a more convenient and personalized financial service, improving living standard and offering more affordable loan products such as car equity loans. Additionally, fintech platforms could utilize algorithms like big data analysis to provide detailed investment advice, empowering those households to participate in the secondary market and achieve their risk diversification. In the long run, the increased investment could foster innovation and new technologies, as well as increasing the amount of available capital stocks. This fosters a supply-side structural reform, paving the way for the future financial openness and solidifying the competitiveness of our fintech industry in China. Ultimately, this evaluates to the international competitiveness and promotes economic growth within the Chinese economy. However, like everything has its side effects. The development of fintech comes with challenges. The intense competition fueled by fintech innovation challenges the traditional equilibrium of the banking sector. Research suggests that the bank's profitability declines more sharply during crisis in countries with higher level of financial innovation. Why is that? This is partly because consumers are drawn to platforms offering higher interest rates, such as Alipay and Ant Group. Furthermore, financial innovations like scrutinization alter the incentive for banks to thoroughly screen and monitor borrowers. While fintech can reduce asymmetric information, it may also encourage risk-taking due to agency problems or lower costs of fragility, indicating a pronounced relationship between financial innovation and banks' fragility. For households, the impact of fintech is a double-edged sword. Despite its merits, it can lead to moral hazards and adverse selection in the credit market. The allure of high interest rate, despite their inherent risks, has drawn regulatory scrutiny, particularly from younger consumers, resulting in a significant debt burden. For businesses, earlier access to loans can lead to overly optimistic investment decisions, promoting this business to hastily assess the feasibility of their projects, potentially leading to financial distress if these ventures fail. On the macro level, the interplay between fintech and unemployment also warrants a careful consideration. So, what is the future? What is tomorrow? The over-innovation led by fierce market competition brings a large number of financial derivatives, which arouses the potential for systematic financial crises such as those triggered by the disruptions in P2P lending. In the short term, this can result in frictional unemployment in the process of job transformation. Additionally, automated trading systems are able to quickly detect these imbalances in supply and demand, leading to sudden price swings and possible market crash. When considering the recent policies enacted by Chinese government, according to the Financial Times, China has adopted a prudent and inclusive regulatory approach for the fintech development. This offers a broad opportunities for those non-banking financial systems to grow inside the Chinese economy. In the recent years, I believe many of you have used Alipay or WeChat Pay for online digital payments. Indeed, the mobile payment businesses witnesses a growth of 75% growth per year between 2015 and 2019, which accounted for a 86% growth of the mobile payment penetration rate in China. China is now encouraging foreign-owned and private companies that are in the fields of fintech to set up in China. While the government is taking steps to deal with the regulatory ropes. For instance, China inspects the activities of fintech companies and internet platforms in order to avoid the misappropriation of the client's funds by those fintech companies who may centralize deposits of these funds at the central bank. Moreover, the Chinese government enacts some restrictions on fintech companies abroad and requires them to cooperate with domestic firms such as becoming a joint venture to ensure that the government can keep an eye on these companies. That is why many international firms such as Blackstone and McKinsey has entered the Chinese economy. This represents that China is focusing on reducing the financial risks caused by fintech firms with an inclusive attitude. However, the dilemma is that over-regulation demotivates the innovation and increase financial market volatility. Policymakers should now strive for a balanced regulation and ensure safe technological progress and maintain the financial stability within the Chinese economy. So, the crux of our conversation on fintech today lies within a single question: to liberate or to regulate. The key, from my perspective, is a harmonized approach and drawing from global experiences. It paves the way for financial innovation, fostering market efficiency while ensuring stability and security. As we adopt this method, we need to balance growth with governance, striving for a financial ecosystem that is resilient and conducive to the ever-evolving global economy. Thank you.